Hi, friends. It's been unusually quiet in the markets. Even with war headlines and political friction, major indices like SPY, Bitcoin, and precious metals have drifted sideways. As I came back from a few weeks focused on personal priorities, I expected to see turbulence, but instead I found stillness. This newsletter looks at what that stillness might mean. Are we in a temporary lull or the beginning of a new phase in market psychology? And how do we prepare portfolios for a world where classic signals are being replaced by complex, contradictory currents? Let's dig in. The market doldrums. After weeks of global conflict news and fiscal showdowns in Washington, markets have remained largely unmoved, not bearish, not bullish, just still. And that kind of quiet can be deceptive. Over $7 trillion now sits in money market funds, and stable coins have reached a market cap of over $250 billion. That's an enormous amount of capital sitting on the sidelines, highly liquid, waiting for a signal. What does it mean when markets don't react? It could mean investors are exhausted. The constant deluge of geopolitical drama, interest rate anxiety, and budget gridlock has trained investors to tune out short-term noise. It could signal uncertainty fatigue, where capital seeks liquidity and safety, not because risk is gone, but because it's everywhere. Or it could mean that the next big move is already forming beneath the surface, but the market's not ready to tip its hand yet. So where is the money going? It appears to be going into cash equivalents like money market funds, stablecoins, and short-term treasuries, and into hedges like gold, silver, and tangible resources, but not yet back into broad equities, growth stocks, or real estate at scale. This positioning suggests investors are prioritizing liquidity, flexibility, and optionality over long-term conviction. It's a defensive posture, not necessarily a pessimistic one. If we're right, this isn't about fear, it's about preparation. So the question becomes, what would need to change for capital to rotate back into risk assets? Upon reflection, it likely requires clear geopolitical de-escalation, credible, stable fiscal and monetary policies, evidence of sustained economic recovery, and signals that inflation and interest rate pressures are easing. Until then, investors are staying light on their feet, and that may be the smartest move of all. But what I've noticed is that not all capital is idle. Some of it is quietly rotating toward new frameworks, going into digital stores of value, assets that generate private cash flow, and systems that offer permissionless access. It occurs to me that this is not just about hedging against risk, but about seeking sovereignty in a shifting world. And it's a natural bridge to another conversation we're having right now about the changing rhythm of Bitcoin. The last Bitcoin cycle. Historically, Bitcoin has followed a well-known pattern: accumulation, breakout, halving, blow off top, crash, and reset. But this time, the pattern appears to be changing. The halving came, yet the price action was muted. The mania phase hasn't followed the usual rhythm. Why? A few major shifts are emerging. One, institutional involvement is reshaping the rhythm. With ETFs, sovereign interest, and new financial instruments allowing indirect Bitcoin exposure, the cycle isn't driven solely by retail hype anymore. It's more regulated, more managed, and potentially more manipulated. Two, liquidity has moved to the edges. More capital sits in money markets, tokenized funds, and off-chain instruments. That means less parabolic upside, but also more structural support. Bitcoin may now move with macro cycles, not just internal supply shocks. Three, The world is watching. Governments, regulators, and banks are no longer ignoring Bitcoin. They are integrating it or competing with it. As a result, price movements are now responding to broader macroeconomic and geopolitical triggers, not just halving events. So, what does this mean for investors who used to count on the cycle? It occurs to me that while the old pattern gave us comfort, this shift may ultimately be a sign of Bitcoin maturing into a real macro asset. Instead of timing a blow off top, we may now need to watch interest rates, not just halving dates, monitor global liquidity conditions, track flows between fiat, crypto, and stablecoin systems, and pay attention to ETF demand and custodial trends in crypto platforms like Coinbase and Binance. More importantly, for us who have been using Bitcoin as an asset to build our nest eggs later in life, does this mean the explosive upside is gone? Not necessarily, but it may not happen in a single vertical move. We may see multiple mini cycles or delayed breakouts tied more to geopolitical instability than technical supply mechanics. If the likes of Michael Saylor and other Bitcoin pundits are right, the rotation of world assets into Bitcoin has a long way to go. It just may take longer to get there. Finally, this shift invites more interest and awareness of what is happening in the broader world, as well as a deeper investor strategy. Rather than just buying and holding, learning to allocate, adjust, and diversify across various financial cycles and asset classes becomes more important than ever. Investor Skills Corner. This issue's glossary highlights some of the concepts and terms referenced in this newsletter. 1. Money market funds. Investment vehicles that offer high liquidity and low risk by investing in short-term government and corporate debt. 2. Stablecoins. Cryptocurrencies designed to maintain a stable value, typically pegged to fiat currencies like the US dollar, used for digital transactions and as a store of value in DeFi. 3. Optionality. The strategic preservation of flexibility, allowing investors to respond quickly to changing market conditions without being locked into a fixed position. 4. Bitcoin halving, an event that occurs approximately every 4 years, cutting the block reward for miners in half. Historically, this reduces supply and is followed by a bull market. 5. Macro asset, a financial asset, e.g., Bitcoin, gold, oil, that is influenced by global economic conditions, not just internal supply and demand. Final thoughts. Stillness is not stagnation, it's strategy. In one half of the market, capital is standing still. In the other, it's rotating silently toward the new frameworks of power, digital stores of value, private cash flow, and permissionless access. Sometimes the best move is to wait. Other times it's to quietly prepare. Whether you're watching for the next wave or adjusting for a new tide, keep asking, are my assets positioned for the world that is emerging, not the one I used to expect? I'd love to hear your feedback on the markets and what they're telling you today. If you'd like to see what we're doing in the community, follow the link in the email to the written version of this Women's Wealthy Ways journal. And if you'd like to learn more or get involved in our Friday discussions, send me an email. I'd love to have you join us.